Hello number-curious friends, welcome to the channel where we talk accounting and finance. In this video, we will apply what we've learned about working capital to real companies. We will have a look at Unilever, PepsiCo and Tesla, who have different business models. And before we start, if you want to test your accounting and finance knowledge, check out our quizzes, link is in the description. We start with Unilever. In 2024, Unilever reported revenue of about 60.8 billion euros. Cost of goods sold was 33.4 billion. From the balance sheet, we also see the key following components: inventory, receivables, payables. These are exactly the inputs we need to analyze working capital. Companies like Unilever tried to operate with efficient working capital, as the amounts involved in it and which can be tied up in the business are huge. In fact, large consumer goods companies often have negative working capital. Negative net working capital means the business actually generates cash from operations. This means that customers pay quickly, inventory turns fast, suppliers are paid later. This is often because of the significant bargaining power these companies have due to their size and influence. Before we move on, if you find our videos useful, please take a moment to hit a like button, subscribe to our channel or leave a comment. That's very important for the channel, and thank you for being with us. Let's have a look at receivables and days sales outstanding at Unilever. On page 140 of the annual report, we find the balance sheet. Here we see accounts receivable grouped within trade and other current receivables. In note 13, we see that trade receivables were 4.2 billion euros in 2024. First, we calculate DSO using the simple method, which is receivables divided by revenue times 365 days. With trade receivables of 4.2 billion and revenue of 60.8 billion in 2024, DSOs will be 4.2 divided by 60.8 times 365 equals 25 days. So, it takes on average less than a month to collect receivables from the customers. With a simple method, we assume revenue is evenly spread across the year. But in reality, sales fluctuate across months due to promotions, seasonality and market demand. Now, imagine what would be if Unilever had strong sales in the last quarter. Year-end receivables would mostly come from the recent months, not the full year. So, instead of averaging across all 12 months, we apply the count-back method. Let's test it. As Unilever doesn't report monthly revenue, we take a look at a quarterly split of it. It was Quarter 1 15 billion, Quarter 2 16.1 billion, Quarter 3 15.2 billion, Quarter 4 14.2 billion. Rather stable, but let's still do the calculations. Step 1. We start with receivables, 4.2 billion. Step 2. We subtract revenue of the fourth quarter. Q4 revenue is 14.2 billion. Receivables are smaller than the Q4 revenue. This means all receivables came from this fourth quarter only. DSOs will be receivables divided by Q4 revenue times 90 days, which is a simplified view on number of days in a quarter. 4.2 divided by 14.2 times 90 equals 27 days. So, using count-back method, DSOs are about 27 days, slightly higher than the simple method where we got 25 days. The reason for that is that Q4 sales are lower than the average of other quarters. Now, let's complete the picture and calculate days inventory outstanding and days payables outstanding. We start with the simple method. With inventory of 5.2 billion and cost of sales of 33.4 billion in 2024, DIOs will be 5.2 divided by 33.4 times 365 equals 57 days. With trade payables of 10.3 billion and cost of sales of 33.4 billion in 2024, DPOs will be 10.3 divided by 33.4 times 365 equals 112 days. Now let's do the count-back method for DPO to compare. Here we run into a problem. Unilever does not report quarterly cost of goods sold. We need to think of a solution here. Let's assume that cost of goods sold as percentage of revenue is stable for the whole year. For the year, it will be 33.4 billion divided by 60.8 billion equals 55%. So, Q4 estimated cost of goods sold will be revenue of 14.2 billion times 55% equals 7.8 billion. Then we calculate DPOs, which will be 10.3 billion divided by 7.8 times 90 equals 118 days. Tell me in the comments what are the options you would consider if there is missing data in company reporting. For days inventory outstanding, we will use the count forward method. Here we take Q1 2025 sales of 14.8 billion at 55% cost of goods sold and get to the estimated cost of goods sold of 8.1 billion. DIO will be 5.2 billion divided by 8.1 times 90 equals 57 days. When compared with the simple method, we get higher days for DPO and similar days for DIO. The reason for these is that the sales in Q4 2024 were lower than average for the year, and Q1 2025 revenue was closer to average in 2024. Let's calculate cash conversion cycle. As a reminder, cash conversion cycle equals DSO plus DIO minus DPO. For simple method it will be 25 plus 57 minus 112 equals minus 30 days. For count back and count forward methods, it will be 27 plus 57 minus 118 equals minus 34 days. We see a difference of 4 days. May seem not too significant, but when we talk about billions of euros in working capital, that makes a difference. Now let's have a look at PepsiCo. Again, we start with simple method. As of December 2024, DSOs were 32, DIOs 46 and DPOs 96 days. And cash conversion cycle was 32 plus 46 minus 96 equals minus 18 days. Now we come to a fun part. With the count back, count forward method for PepsiCo, we need to be careful. PepsiCo reports on the basis of 12 weeks, not 3 months. That means first 3 quarters will have 84 days each, and as a result, there is a shift in days into the last quarter. It has more than 90 days, 113. On this basis, DSOs in December 24 were 33 days, DIO were 56 days, and DPO were 94 days. Note how significant the difference in DIO is. This is driven by the seasonality in the business of PepsiCo. Lower sales in Q1 2025. They were 7.9 billion compared to average quarterly of 10.4 billion in 2024. Now let's check the new cash conversion cycle. It will be 33 plus 56 minus 94 equals minus 5 days. So, from minus 18 days it became minus 5 days. 2 weeks of a difference, quite a lot. In comparison to Unilever, this tells us that PepsiCo pays suppliers faster than Unilever, or has less negotiating power, or operates with different supply chain dynamics. Now let's have a look at Tesla, a very different type of business. We will do only the count back, count forward methods here, to keep it shorter. Tesla reports calendar quarters, so we use 90 days in formulas. On this basis, DSO in December 24 were 15 days, DIO were 67 days, and DPO were 52 days. This gives us cash conversion cycle of 15 plus 67 minus 52 equals 30 days. So it is positive, unlike retail companies of Unilever and PepsiCo, and seems to be driven by higher DIOs, manufacturing and selling cars can take longer than juice or soap, and higher DPO. Supplier pool for Tesla is different to retail companies. What do we typically see for companies like Unilever? Relatively low DSO. Customers pay quickly. Stable inventory levels despite growth. High payables, strong supplier terms. This combination leads to a short or even negative cash conversion cycle. In simple terms, Unilever and PepsiCo get cash from customers before they pay suppliers. That's a strong business model. And that's the snapshot of the net working capital KPIs in real companies. In the next video, we will look into net debt. If you have other questions, post them in the comments below. Thank you for watching. If you enjoyed this video, hit like, subscribe and ring the bell so that you don't miss the next video. See you soon and keep those debits equal to your credits.